understand the overview of the time value of money. So before moving ahead, you should understand what are the basic pattern of cash flows. Okay, so what is cash flow? The amount you will get at the start or at the end of the years, normally known as cash flows. Okay, so there are some terms you need to understand. The first one is future value. Future value, as name suggests, the amount you will receive after depositing or after investing based on your interest rate. So anything you would receive at the end known as future value, and we simplified it as FV. And if we talk about the present value, in other terms, the amount you will get today, or the amount you are going to invest today, or amount you are deposit today, or amount you are going to borrow today, known as present value. And this is defined as, or if we write it in a simplified form, we normally said it's PV. And the other one is interest rate. We normally said this is I. Okay, so amount that you will earn on your deposits become the part of your principal at the end of specific time period. So remember that present value, it's your investment amount. Normally consider it as principal amount. Okay, amount you will invest in base year. So normally we consider it as time value of money. Now, so for how many times, for how many years you are going to deposit or you are going to invest your money, time or maturity, but you just have to remember the time span. Normally we consider it, or we show this as t. It's a small t, and n, number of months, number of years, depends on the situation. So all these terms we will you just need to understand, or you just need to remember that, because we have a formula which is based on these terminologies. So what we were saying, we were understanding the basic pattern of the cash flow. Number one, we have single amount. What we have? Single amount. Okay, the amount you will earn or you will get lump sum after specific time periods. It could be either present value or either future value. For example, if you are investing 10,000 and bank said that you will get at the end of years, it could be 8%, so lump sum amount would be like 10,080 rupees. So this is the single amount. Now, the next case is annuity. What is annuity? Annuity is the equal periodic cash flow stream. Equal periodic cash flow stream. For example, 0, 1, 2, 3, 4. If you are investing, let's say 10,000 present value, and you are getting, assume that 40,000 at the end of, or at the end of your maturity time, or at the end of specific time period, or at the end of year 4. So how much you will get? 10,000 after year 1, 10,000 after year 2, 10,000 year 4, 10,000 year last year, which is basically year number 4. Remember that normally we denote that amount, or we shows that amount in a negative CF. Like it's a cash flow, but it's a negative because something which is going outside from the business or from the individual hand. Okay, so this is cash inflow and outflow. So that is the situation of the cash outflow, cash which is going outside. That's why we are mentioning negative with that particular amount. So all these amounts remaining 10,000, 10,000, we will indicate with the plus sign. Okay, so what I am saying, NOT equal periodic, what I am saying, equal periodic cash flow stream. So what you are getting, equal amount in every year. Okay, 10,000, 10,000, 10,000, 10,000. So that's become equal periodic. When you get equal cash flow, or you will get same cash flow in each year, that's become the NOT case. So whenever we will solve these questions, you just have to remember that if you have a very simple case, so that's mean we are talking about a single amounts, and but if you are in a position to get same amounts in a different time span or a different time periods, that become the NOT case. Okay, what we do, we divide the NOT case into two parts. So the first one is NOT ordinary. Okay, whenever you will receive amount or you will invest amount at the end of year, that would be the case of NOT ordinary. Whenever you will invest amount into the, or you will get amount at the end of the year, whenever we talk about at the end of the months, at the end of the day, at the end of the years, that's become the NOT ordinary case. For example, if you are what will you do, you normally serve the company, and at the end of the month they will give you a salary. Okay, so that salary you can say becomes the part of NOT ordinary, because for a 6 month, for example, if you are getting same amount of salary, let's say 50,000, so year at the end of year 1 you will get that salary, year 2 you will get same salary, year 3, year 4, year 5, year 6, or you can say it's 6 months. So you are receiving amount at the end of the months or at the end of the year. That is the case of NOT ordinary. The next is NOT due. So whenever we talk about start of the year, that's become NOT due. Whenever you will serve the company, and sometimes you have a positions to, you know, get money, or for example in case of a rent, if you are if you have a home, or you just have to pay a rent for, it could be a let's say it could be a shop, it could be a home, it could be anything. If you are going to pay in advance, that's become NOT due case. We have a different formulas. First we will see the time value of money in case of single amount, and then we will see in shape of NOT. So we have a two different case. The first case we will see in a single amount, and the other one would be in the NOT case. So that is the basic overview of the time value of money. In the next lecture we will solve a few questions just to get better understanding that how that things works.